What is PMI or mortgage insurance? So if you're buying a house with less than 20% down and you're doing a conventional mortgage, you are going to have what's known as PMI, private mortgage insurance. Now, first of all, you're like, oh, well, does that protect my mortgage in case I die? No. It doesn't protect you at all. What private mortgage insurance does is it protects the bank in case you foreclose. It's insuring the loan. And when you're putting down less than 20%, you're considered higher risk. So that is why there's private mortgage insurance, PMI. Now, sometimes people go, I've heard about that. That's why you want to put 20% down because it's so expensive. It's really not. That's the thing. The thing to know about PMI is that the way that a lender prices it is they price it based on your debt to income as well as your credit score. So if your credit score is really good, mortgage insurance is surprisingly cheap. You know, I've had buyers where I'm like, it's $20. And they're like, what? I thought it was going to be $800. I'm like, no, it's $20 a month. You know, because sometimes what I'll see people liquidating stocks and retirement and all this crazy stuff to get to 20%. And I'm like, hey, can I just show you the numbers? And I'll be like, let me show you 10% down, 15% down, 5% down, right? Because beyond the debt to income and the credit score, the loan to value is also in the mix when we're pricing mortgage insurance. You know, the theory is that the less you put down, the higher the risk. But even at the 3% or 5%, if your credit's good, the mortgage insurance is not bad at all, okay? Where the mortgage insurance gets really expensive is if, you know, with a conventional mortgage right now, as I film this, the minimum credit score is 620. So if you have a 620 credit score, mortgage insurance can get very expensive. That's why often you'll see lenders go, hey, maybe we should look at FHA, okay? It's if you have that lower credit score because the mortgage insurance can get really, really expensive, okay? But if your credit's good, it's not. And that's the thing. And I think that's the most important part about this video is like, look, does it protect you? No. Does it protect the lender? Yes. If you're doing less than 20%, is it required? Yes. Is it crazy expensive? No. It's going to depend on the credit score, the loan to value, and the debt to income. And on that debt to income range, the only time it comes into play is if you're really high. You know, if you're under 44, I don't usually see the mortgage insurance going up, but if you start pushing towards 50, I do. So I'll tell my clients, hey, we got to somehow keep you here because otherwise, you know, this goes from this to that, right? And that's the thing. You want to make sure that you have these transparent conversations with the lender, but mortgage insurance is nothing to be afraid of. With a conventional mortgage, it's not for the life of the loan. So if, for instance, let's say you pay down your mortgage and you hit 80%. So I'm doing easy math. Let's say the house was, don't laugh, because I know I'm going to get comments that say, this isn't a real number, Jen. Where can you find this? I know, easy math. So if you buy a house that's $100,000, let's say you put 5% down. Well, when you get that mortgage balance to about $79,000, $78,000, at that point, you know, the mortgage company will remove the mortgage insurance as long as you've made your payments on time. And you can always call them too and say, hey, take it off now. You know, I'm under 80%, let's go, right? That's one way to do it. Another way to do it is, let's say the value of your house goes up a lot. Let's say that you've lived there for 3 years and wow, that number jumped. If you call the servicer, that's who sends you the bill, and you say, hey, I want to get rid of my mortgage insurance, my house is worth a lot more. In a situation like that, where it's based off of value, they're going to do some sort of appraisal, but that's another way to get rid of mortgage insurance. So, you know, is it the big bad wolf that everyone says? No, it's not. And look, there's other options as well. So with mortgage insurance, you can do a one-time lump sum up front. You don't have to have it monthly. You can do the lump sum. Personally, I don't recommend that. And the reason I don't recommend that is it's like paying your car insurance up front for 8 years, you know, and knowing that you can get rid of mortgage insurance if the value goes up or if you start really whacking it away. I would be hesitant to pay that lump payment because that lump payment is assuming that none of that good stuff happens. So some lenders really like to push the lump payment because it makes your payment a little lower, so it sounds good. I don't like it because I don't think it's a great use of your money. And I think there's a chance you're gonna get out cheaper. The other way you can do it is like split, where you pay a partial lump up front and then a lower amount monthly. Once again, it's like, if your credit's good, let's say over 700, it's not brutal at all. 680, 660, that's where we're gonna start comparing it against FHA, because FHA has mortgage insurance and it's the same no matter what your credit score is, okay? But the key is having these conversations and not being afraid of mortgage insurance. You don't have to have 20% down to buy a house. Please do not liquidate your stocks. Don't liquidate your retirement. Talk with the lender about how much the mortgage insurance is going to cost before you do any of that. Because what I see more times than not is people go, I'm so glad you told me that. I'm so glad, right? Because you're going to pay money on stocks. You're going to pay taxes if you liquidate them and you made money. Retirement, same thing, taxes. So how can we avoid those taxes? So I hope this video was helpful. If you have questions, just reach out, okay? We've got a new team phone number, and that number is 786-933-2077. I'll probably read it forever. I just want to put that in there. But yeah, mortgage insurance is not the big bad wolf you have heard of. Don't be afraid.